Welcome to our channel. Today we're diving into the essential steps for building a diversified portfolio for long-term growth. Whether you're saving for retirement, a new home, or your child's education, this guide will help you navigate the complexities of investing. We'll cover defining your investment goals, assessing your risk tolerance, understanding different asset classes, and choosing the right investment vehicles. By the end of this video, you'll have a comprehensive understanding of portfolio diversification and be well equipped to start building a robust investment strategy tailored to your specific needs and goals. So let's get started. Before you even think about buying a stock, a bond, or even that rental property you've had your eye on, we need to take a step back and define what you're actually investing for. What are your financial goals? Are you looking to retire early, buy your dream home, or perhaps secure your children's education? Clearly defining your goals is crucial because it will dictate your investment time horizon. For example, if you're investing for retirement 30 years down the line, you have a much longer time horizon compared to someone saving for a down payment on a house in the next 5 years. The longer your time horizon, the more risk you can generally afford to take. Shorter time horizons might require a more conservative approach. Will you need to withdraw money from your investments regularly, say for living expenses in retirement, or are you primarily focused on long-term growth? This is another crucial factor to consider as it will influence your asset allocation and the types of investments you choose. Alright, now let's talk about something that often gets overlooked, your risk tolerance. This is essentially how comfortable you are with the ups and downs of the market. Are you someone who can stomach seeing your portfolio drop 20% in a market downturn, or would that keep you up at night? Understanding your risk tolerance is crucial because it will determine how you react to market fluctuations and whether you'll stay the course with your investment strategy. Remember, investing is a marathon, not a sprint, and emotional decisions based on short-term market movements can be detrimental to your long-term returns. There are several ways to assess your risk tolerance. You can find online questionnaires or even consult with a financial advisor. These tools can help you gain a better understanding of your risk appetite and guide you towards an investment strategy that aligns with your comfort level. A common misconception is that higher risk always equals higher returns. While it's true that riskier assets like stocks have the potential for higher returns, they also come with a higher chance of losing money. It's about finding the right balance that allows you to sleep well at night while still working towards your financial goals. Let's dive into the building blocks of any diversified portfolio asset classes. Asset classes are categories of investments with unique risk and return characteristics. Equities or stocks represent ownership in a company. Stocks offer high growth potential but higher volatility. Fixed income includes bonds, loans to governments or corporations. Real estate can be direct property investment or through REITs. Commodities like gold and oil can hedge against inflation. Cash equivalents include savings accounts and treasury bills. Now that we've covered the major asset classes, let's talk about how to put them together in a diversified portfolio. This is where asset allocation comes in. Simply put, asset allocation is the process of dividing your investment portfolio among different asset classes. A common rule of thumb is the 100 minus your age rule. This suggests that you subtract your age from 100, and that number represents the percentage of your portfolio that should be allocated to stocks. For example, if you're 30 years old, you would allocate 70% to stocks and the remaining 30% to bonds and other asset classes. Of course, this is just a starting point, and your actual asset allocation will depend on your risk tolerance, time horizon, and financial goals. For a conservative investor, a portfolio heavily weighted towards bonds, 60 to 70%, with a smaller allocation to stocks, 20 to 30%, and a small portion in cash equivalents, 10%, might be suitable. A moderate investor might opt for a more balanced approach with a 50-50 split between stocks and bonds, or a 60-40 portfolio with a slightly higher allocation to stocks. Now, diversification goes beyond just spreading your money across different asset classes. You also want to diversify each asset class. For equities, this means investing in different sectors and geographies. Don't put all your eggs in one basket, or in this case, one industry or country. Invest in a mix of sectors like technology, healthcare, financials, and international stocks from both developed and emerging markets. For bonds, you can diversify by varying the maturity dates, also known as duration, and credit quality of the bonds you hold. Even within real estate, you can diversify by property type: residential, commercial, industrial, and location. By investing in a variety of assets that are not perfectly correlated, you're reducing the impact that any single investment can have on your overall portfolio. Now that you understand asset allocation and diversification, let's talk about the different investment vehicles you can use to build your portfolio. Mutual funds and ETFs are a popular choice for many investors, especially beginners, because they offer instant diversification. Index funds, in particular, are a low-cost and effective way to track a specific market index, like the S&P 500. You can also find sector-specific or international funds if you want to target specific areas of the market. For those who have the knowledge and time, investing in individual stocks and bonds can offer more control and potentially higher returns. However, it also requires more research, due diligence, and active management. Robo-advisors have gained popularity in recent years as an automated way to invest. These platforms use algorithms to create and manage diversified portfolios based on your risk tolerance and financial goals. Building a diversified portfolio isn't a set-it-and-forget-it type of deal. It's essential to regularly monitor your investments and make adjustments as needed. Make it a habit to review your portfolio performance at least once a quarter, or even monthly. Look at how your different investments are performing and whether your asset allocation is still aligned with your goals and risk tolerance. Over time, as your investments perform differently, your portfolio can drift from its target allocation. This is where rebalancing comes in. Rebalancing involves selling some of your winners and buying more of your laggards to bring your portfolio back to its original asset allocation. Life is full of surprises, and your financial situation and goals might change over time. Now let's talk about taxes. While taxes shouldn't be the primary driver of your investment decisions, they can significantly impact your net returns. One of the smartest things you can do is to take advantage of tax-advantaged accounts like IRAs and 401(k)s. These accounts allow your investments to grow tax-deferred, meaning you won't pay taxes on your earnings until you withdraw the money in retirement. When it comes to taxable accounts, be mindful of capital gains tax. If you sell an investment for a profit, you'll owe taxes on those gains. Holding your investments for the long term, longer than a year, can qualify you for lower long-term capital gains tax rates. It's always a good idea to consult with a qualified tax advisor to understand the tax implications of your investment decisions. The world of investing is constantly evolving. What worked yesterday might not necessarily work tomorrow. That's why it's crucial to stay informed and continue educating yourself about personal finance and investing. Make it a habit to stay updated on market trends, economic indicators, and changes in investment strategies. Read financial news, listen to podcasts, and follow reputable financial websites and blogs. Consider taking online courses or attending workshops to deepen your understanding of investing. The more you learn, the better equipped you'll be to make informed investment decisions and navigate the complexities of the market. Now, I know we've covered a lot of ground today, and investing can seem overwhelming, especially if you're just starting. If you're feeling lost or unsure about how to apply these principles to your unique situation, don't hesitate to seek professional guidance from a qualified financial advisor. A financial advisor can provide personalized advice tailored to your specific financial goals, risk tolerance, and time horizon. They can help you create a comprehensive financial plan, choose the right investment vehicles, and navigate complex financial decisions. Think of a financial advisor as a financial coach who can guide you towards making smart financial decisions and keep you accountable for your long-term goals. Seeking professional help is a sign of wisdom and shows that you're serious about taking control of your finances. Thanks for watching. If you found this guide helpful, don't forget to like, subscribe, and hit the notification bell for more insightful content on personal finance and investing. See you in the next video. Remember, building a well-diversified portfolio is an ongoing journey, not a one-time event. By understanding your financial goals, risk tolerance, and the principles of diversification, you'll be well on your way to building a solid financial foundation for a brighter future. So start investing in yourself and your financial future today.